This week we saw monetary policy decisions in the US, UK and Japan. Only the Bank of England raised interest rates, but it was clear that the Federal Reserve is by far the most confident of the major central banks. For some years, the Fed has only changed policy at the quarterly meetings, which include new forecasts and a press conference. So it was no surprise that this week's meeting saw a steady hand on interest rates. But the carefully worded FOMC statement sent a clear message that further rate rises were planned. Notably, the Fed used the word strong in the opening sentence to describe the pace of US economic expansion. This was an upgrade from solid, implying that the FOMC was quite impressed with the advanced Q2 GDP report. This showed an eye-catching 4.1% annualized pace. If reported in the same manner as Australia and most other countries, the headline growth rate would have been 1% on the quarter, 2.8% over the year. This is not remarkable compared to Australia, for example, which in Q1 printed growth of 1% on the quarter, 3.1% over the year. But US growth is definitely heading in the right direction. With the unemployment rate around 18-year lows and fiscal stimulus still flowing through, the Fed looks intent on raising rates again, brushing aside concerns over US trade policy. Westpac looks for the federal funds rate to be raised in both September and December to a range of 2.25% to 2.5% by year end. Such an outcome is not yet fully factored into markets, but a September hike is already 90% priced in. This should provide underlying support for the US dollar in coming weeks. In contrast, this week the Bank of Japan lowered its inflation forecasts and committed to keeping interest rates extremely low for, quote, an extended period of time. In particular, they sound worried about their possible impact on consumer spending of the consumption tax rise the government has planned for October 2019. The Bank of England raised interest rates for only the second time since the global financial crisis to just 0.75%. The bank noted the UK's low unemployment rate and inflation running above the 2% target. However, it projects economic growth to average only 1.75% in coming years and stressed that any future rate rises would be, quote, at a gradual pace and to a limited extent. So there is limited fresh support from the pound from UK interest rates. But we can say the same for the Aussie dollar. The RBA meets on Tuesday with markets pricing 0% chance of a move in the 1.5% cash rate until 2019. We will also hear from Governor Lowe in a speech on Wednesday and then see the August statement on monetary policy on Friday. Westpac expects the RBA's 2018 and 2019 forecast for growth and inflation to be unchanged and for the extended horizon to December 2020 to show inflation lifting off the bottom of their 2 to 3% target range. So RBA commentary should be the domestic focus for the Australian dollar next week. But with the RBA firmly on hold, global factors are more likely to be the catalyst for any break of the 73 to 75 cent range, which has held since early June. In particular, we'll be watching to see if the US-China trade war causes further damage to Australia's key commodity prices and regional equity markets. We'll speak to you next week.